Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Martin. Hi Alan, I prefer to trade the poor man's covered calls in my account because it's a small account. And my question is, what do you do when the LEAPS gets out of the money? Well, how do you manage that trade? I bought PPL LEAPS January 2021 expirations at a $30 strike when the stock was trading at $35.42 and way before the coronavirus crash. But now the stock is at 25. It was at 19 at some point. And my shorts are becoming worthless and not too many good strikes at the 30-ish level. I'm a bit sure how to trade it from here. In order to get a decent premium, I would have to go below the 30 LEAPS strike. I'm asking to see how you would manage it to learn, not as advice as to what to do. Thank you for your input, and it's signed, Martin. Okay, so for those of you out there not familiar with the poor man's covered call, I call this a covered call writing like strategy in our book, Covered Call Writing Alternative Strategies. So it is covered call writing, but with a twist. Now, instead of buying a stock and then writing a call option against that stock, we are buying a long-term, generally deep in the money LEAPS option. So an option that expires 1 to 2 years down the road. So we're taking on a long-term commitment. Once we own this LEAPS option, having the right to purchase the stock at the strike price, we are now free to write a call against that. And generally, we will write a slightly out of the money call 1 month out. So that's generally how it works. The reason people love this strategy is because we're spending less money to get into the trade because the options cost less than the stock. So if our cost basis is lower, the thinking goes, the return on our capital will be that much greater. However, let me just give you a warning here. There are a lot of moving parts to this strategy. Half of that book I just alluded to is dedicated to it. So you have to understand all the pros and cons and all the nuances of the strategy before you consider using it as your go-to strategy. And it may or may not be. So that said, let's review Martin's trade and see if we can make sense out of how to manage it. On February 20th, 2020, PPL was trading at $35.42 and Martin purchased the in-the-money LEAPS, $30 LEAPS option expiring January 15th, 21, and he paid $5.70. Then he sold the slightly out of the money 36 call option, and that generated 30 cents. So that was the initial setup of the trade. And now let's feed that information into the BCI Poor Man's Covered Call calculator. And the information that we just alluded to is in the white cells on the top. We just feed that in there, and then the remaining cells below are populated with calculations, and I highlighted some of the important cells that I want to allude to now. Now, the brown cell shows that the initial time value return came out to 60 cents. Now, that was on a cost basis of $5.70. Not on the price of the stock, which was above 35. So then if we move down to the yellow cells, you'll see that the initial return on capital was 5.26% for the month and an additional upside potential of 10.18%. That means the total possible kind of ideal world maximum return for the 1 month is 15.44%. So you could see here, based on these statistics, how by lowering your cost basis using options instead of stocks, the returns can look phenomenal. But as I said, there are a lot of moving parts to this strategy, so you must learn about them, and you must collate that into your decision as to whether or not this is the right strategy for you and your family. Now, way down at the bottom of the spreadsheet, you'll see the buy to close prices when the trade was entered. So much like traditional covered call writing, we have the 20%, 10% guidelines, which tells us when to close the short call. Now, in this particular case, the price of the stock dropped below the $30 LEAPS strike price. And Martin is a little concerned as to what to do because right now, to write a call option, a short-term call option at the $30 level is not going to generate any premium. So here's how we look at it. We say to ourselves, was the initial formula appropriate to enter the trade? We'll address that in the next slide. Then we ask ourselves, is this a stock that we still have confidence in? Because we had a bullish assumption about it when we entered the trade. Otherwise, we wouldn't have used PPL. So in this case, I'm going to kind of speak a little bit for Martin here, but I could be wrong. You realize that the price of the stock declined not because something went wrong with the company, but because of the overall market going down relating to the coronavirus crisis. Everything went down at that point in time. So PPL was no exception. So there's probably nothing at all wrong with PPL at that point in time. Let's assume for a moment that we decide that we still want to retain this particular security in our portfolio. If not, we would have to close the trade and take a loss. And sometimes we just have to do that. But in this particular case, wasn't a corporation issue, but rather an entire market issue. So we view it almost like a stock that's gapped down, but not for a critical reason. Maybe an analyst downgraded it, one analyst, and it dropped a little bit. And you figure, well, it's still a great company with great earnings and such. I'm going to hold on to it, and then the next thing you know, it bounces back up again. So we're going to make that assumption. Let's first have a look at how Martin initialized the trade and see if it met our BCI required formula. So the formula before we enter a trade is we want to make sure that if the price of the stock goes way up, finding both strikes deep in the money, we can close at a profit. So the formula is the difference between the two strikes, the leaps and the short call, plus the initial premium we generated when we sold our first slightly out of the money short-term call option should be greater than what we paid for the leaps option. So in this particular case, the difference between the strikes is 36 minus 30, or $6, and we generated 30 cents on the sale of the first call option. And the price of the stock was $5.70. So it does meet our requirement. $6.30 is in fact greater than $5.70. Now, the initial time value of return, we go back to that, showing a whopping 5.26% for the month, and the upside a whopping 10.18%. So initially, the trade is looking quite well. Now, Martin alluded to the fact that the price of the stock went down when everybody was concerned about the impact coronavirus would have on our economy and therefore on our stocks. And here's a chart showing that mega drop in price. Now, if you look at the point where the arrow is, where the trade was entered, you could see that the trend was fabulous. The price was going up and then consolidating, going up and then consolidating. Perfect, just what we want to see. But then all of a sudden, the coronavirus hit and the price of the stock gapped down, huge gap down. And you could see on the right side that it gapped down currently at 26.70 when I made this screenshot, and it had been way lower than that. So that just goes to show you how one event, it's rare, but one event can impact the entire market. Now, what to do? Well, we made the assumption that we're going to keep the stock because we still love the company, and we know that the gap down was related to the overall market. So what are our choices on how to manage a trade like this? Well, managing a trade when a stock gaps down is the same as it is with traditional covered call writing. The active leg of the exit strategy aspect is related to the short call, not to the leaps. Now, if we were going to close our entire position, yes, we'd have to sell the leaps. We'd buy back the short call, sell the leaps, and have a loss. Not every trade is going to be a winner. But in this particular case, we still have some faith in the underlying security. So we're going to have a look at what our exit strategy opportunities are. Now, once we sell the short call, we immediately put in the buy to close order to buy back that short call. Remember, we sell to open and buy to close. And we do that at 20%. And it's going to be, since it was only 30 cents initially, it's going to be about a nickel that we're going to put in a buy to close order on that. And if it's exercised, the option is bought back. And then we could look for either rolling down. If the price of the stock is going up, we're going to consider rolling up in the same contract month, something we don't do with traditional covered call writing. We might roll out if the price of the stock is in the money as expiration is approaching, or for more bullish, even out and up. So those are all opportunities available to us, along with hitting a double, where we buy back the option, give it a few days, and then sell the same option if there is a price share recovery. And then, of course, as I said earlier, reassessing our bullish assumption if we feel, you know what, this price went down because of an individual company matter, maybe some fraud on the part of the board of directors, something really egregious, then we might just close that position, buy back the short call, sell the leaps option, close probably at a loss, and then move on, take that money, and move on to another position. Now, what about exit strategies on the leaps side? Generally, the leaps option is not managed to the extent that the short call is, because we are, in essence, undertaking a long-term position here. As I said, if your bullish assumption changes, then you have to close it out. Let's say we don't. Well, leaps expire, stocks don't. So if you're doing the poor man's covered call, then you're going to have to consider rolling that leaps position as expiration is approaching. And the BCI guideline for that, since theta destroys the time value as expiration is approaching, if we have a 1 or 2 year out leaps, we'll roll that, sell it, and buy a new one that expires further out. We'll roll it 3 months prior to contract expiration. So that's the BCI guideline, 3 months prior to expiration. But where are we going to get the money to fund that roll? Because it's going to cost us between $2 and $3 a share to roll that option. Well, that's something that I address in the book, and something that I want to make sure you think about before you use the poor man's covered call. Let's review. We first have to make sure that the initialization formula is reached if we're using the poor man's covered call. Once again, the difference between the strikes plus the first short call premium must be greater than the price we paid to buy the leaps option. Now, we are in a position for position management mode once we enter the trade, so we have to be prepared. As I said, I immediately enter buy to close limit orders, whether I'm using the poor man's covered call or more frequently traditional covered call writing. The entire arsenal is available to us, and after entering our 20%, 10% guidelines. There are several exit strategies that will allow us to either mitigate losses or enhance gains, and we have to be prepared to take advantage of those opportunities. And then, of course, rolling the leaps option when expiration is approaching. Once again, I use it 3 months prior to contract expiration. So for those of you interested in this strategy, we do have some products available. I feel, as far as the information in our book, Covered Call Writing Alternative Strategies, of course, you make the final decision, but I think it's the resource that offers the most information on this strategy found anywhere. We also developed the Poor Man's Covered Call Calculator that's available in the Blue Collar store along with this book that you see here, Covered Call Writing Alternative Strategies. Okay, before I sign off, I just want to remind you, our premium members, that the entire Ask Alan library of over 170 at the time that I'm making this video, Ask Alan videos, are available only to our premium members. You log into your member site, scroll down on the left side where you see the arrow on your screenshot there, and you'll see the first 10 Ask Alan videos. The link below it will open up the links for all the others. And we add one new Ask Alan video each month. Once again, available only to our premium members as it relates to the entire library. Now, on the right side of the member site, if you go to the scroll down the A's, we have an Ask Alan file of video titles if you want to check out the videos on a particular topic. So once again, this is the number 177, and we're going to continue to add every single month a new video for our members. So Martin, if we still like the stock and it gaps down, then we're going to roll down to an out of the money strike and continue writing calls and allow for share recovery. That's the way we do it. So if for any reason you feel that your bullish assumption has changed, close your trade, even if it is at a loss, and move on to another underlying security. This particular case, I think I would still like PPL, but that's something that each individual investor has to decide on. So thank you so much, Martin, for this question. For those using this strategy, it's an important one. It doesn't come up that often, but every so often the price will gap down to below the leap strike. Then what do? Well, do the same thing as we would an individual stock. Would we want to own that stock today? If the answer is yes, then we roll down to out of the money strikes and continue the process. If the answer is no, we close at a loss. So thank you so much, Martin, for bringing this question and allowing me to share the information to the BCI community. And thanks to you, everybody out there watching this video. Appreciate your attendance here, and I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.